All right, let's talk about your long-term stock portfolio. You know, the one with the stocks you plan on holding forever. What if I told you those very holdings could start generating some serious cash flow every single month without you having to sell a single share? Well, the source material we're digging into today lays out a pretty conservative strategy to do exactly that. Let's break it down.
And this is the big question, isn't it? It's the core dilemma for so many long-term investors. You believe in these companies for the long haul, maybe for the next 10, 20 years. But man, some extra income today would be nice too. So how do you get the best of both worlds without selling off the very assets you're so committed to? And this slide just lays it all out perfectly. On one side, you've got your portfolio growth. That's the whole reason you bought the stocks, right? You're playing the long game, waiting for them to appreciate. But on the other side, there's the appeal of cash flow, getting regular, usable income from your assets. The strategy we're exploring today tries to find a sweet spot right in the middle of these two ideas. So, let's really get into the mind of a long-term investor. You've got these core stocks you absolutely believe in. So why don't more people try to generate income from them? Well, according to our source material, it all boils down to one very powerful emotion. And there it is, fear, plain and simple. The number one thing holding people back is the fear of being forced to sell those stocks they cherish. I mean, think about it. If a stock you've held forever suddenly gets sold, you're looking at a potential tax hit, and maybe even worse, you miss out on all that future growth we're banking on. That fear is what keeps that portfolio locked up tight. So how do you get around this totally legitimate fear of losing your prized stocks? The source material we're looking at suggests it's not about taking on some wild, crazy risk. Nope, it's about minimizing that risk with a very specific, very conservative approach. The keywords you really gotta hear are ultra-conservative. This is not your typical aggressive options trading. This is a method designed from the ground up for people who want that income, but who also want to make the odds of actually having to sell their shares incredibly, incredibly low. Okay, theory is great and all, but to really get this, we need to see how it plays out in the real world. And luckily, our source provides a fantastic real-world example that shows us exactly how this conservative strategy is supposed to work. First, though, a super quick refresher just so we're all on the same page. A covered call is actually pretty straightforward. You own at least 100 shares of a stock, then you sell someone the right, not an obligation, just the right, to buy those shares from you at a higher price, which is called the strike price. In exchange for selling them that right, you get paid cash right here, right now. And that cash is called the premium. All right, let's get into the nitty-gritty from the source's example. They're using 1,000 shares of MicroStrategy, ticker MSTR. The time frame for the trade is about a month to a month and a half. Now, the really crucial number on this screen is the delta, which is just 5. Now, a simple way to think about delta is that it's the market's approximate guess at the probability of the stock hitting your strike price. So a 5 delta means there's only about a 5% chance of that happening. And that strike price, a massive $1,050. Now, this is where it gets really interesting, because look at that gap. At the time this trade was made, the stock was trading around $388. The strike price chosen was over $1,000. That means the strike is 170% out of the money. That's just a fancy way of saying the current price is nowhere near the price you'd have to sell at. The stock would literally have to almost triple in about a month for you to be at risk of selling. That's a huge, huge safety buffer. Okay, so you've set up this trade with a massive margin of safety. You're taking on what seems like a very, very small risk. So what's the reward? What's the payoff for doing that? Let's take a look at the numbers. And boom, here it is. According to the source, this one single trade generated an immediate cash payment of $15,795. That's not potential money, that's cash deposited directly into the account right away. All for just agreeing to sell your shares at a price that's nearly triple what they're currently worth. And this chart just visualizes those odds perfectly. Remember that 5 delta we talked about? Well, here it is in picture form. According to the market data, there's a 95% chance that the stock will stay below that $1050 strike price. This right here is the heart of that ultra-conservative approach. You're basically playing a game with the odds stacked heavily in your favor. The source also points out a pretty cool bonus. You don't always have to wait the full month for the trade to expire. If the stock price actually drops a little bit, the value of that option you sold plummets.
So you can just buy it back for way less than you sold it for, lock in your profit early, and then you're free to do the whole thing all over again. So let's recap. A huge potential payday, a super high probability of success, and even a chance to get out early with a profit. This is starting to sound a little too good to be true, right? And whenever anything sounds like that in the world of investing, you have to ask yourself, what's the catch? And the source is very clear that this is not a risk-free strategy. And the author puts it perfectly with this quote. This is not some magical money-making machine. There is a risk involved, even if it's a small one. And that premium, that cash you get up front, that's you being paid to take on that risk. So here it is, the big what if. What happens if the unthinkable occurs? What if MicroStrategy goes on an absolutely legendary run and rockets up 170% in a single month? I mean, that 5% scenario? Sometimes it hits. What's your game plan then?
Well, you're not helpless. The source actually outlines a two-part playbook. The first move is to roll the position. That basically just means you buy back the option that's about to be in the money, and you sell a new one at an even higher strike price and a later date. Oftentimes, you even collect more cash for doing it. The second option is just to let it happen. Let your shares get sold for that really high price of $10.50, and then you could just wait for the stock to have a pullback before you buy your shares back.
And this might be the most crucial piece of advice in the whole thing. This is not a set it and forget it strategy. To manage that small but very real risk, the author makes it crystal clear that you have to learn how to properly roll your positions. It's all about active management when and if your position ever gets tested. And so it all boils down to this one fundamental trade-off. Is that predictable, repeatable cash flow worth giving up the lottery ticket? Are you willing to trade that tiny chance of a mind-blowing, unpredictable price surge for the high probability of a steady paycheck from your portfolio? The source gives us a fascinating blueprint, but whether that trade-off is right for you, well, that's the ultimate question every investor has to answer for themselves.